Thank you very much. Good afternoon, everyone. I am Wakatsuki, co-president of Nippon Paint Holdings. Thank you very much for taking time out of your busy schedules to join us today. I would now like to provide an update on Nippon Paint's medium-term strategy. Members of the media are also attending this briefing. Thank you very much for your support. First is today's summary, page 3. There is no change to the medium-term strategy that we explained in April last year. Our belief that the asset assembler model is our strength remains unchanged under MSV, our mission of maximizing shareholder value. This asset assembler model may appear low profile, but by assembling solid companies, we aim to compound low-risk, sustainable EPS. In such excellent companies, we require the autonomy and accountability of excellent management teams, which ultimately brings out the full potential of the assets. Last year, I said that of the two pillars of our model, organic and inorganic initiatives, we can compound EPS without limits for inorganic growth, regardless of region, business area, or size, provided it offers low risk and good returns. But we received many comments saying that it was difficult to have concrete image, as we could not disclose specific targets. Then we announced the acquisition of AOC in October last year and closed it last month, which I think helped your understanding. I will elaborate further today. As shown in the upward revision of the guidance announced today, this M&A can contribute to a significant accretion in EPS from year one and is in line with our strategy from diverse perspectives. Let me briefly mention synergy here. I have always said that acquisitions that make synergy the goal run the risk of overpricing, and that sufficient profitability is important on a standalone basis. And this acquisition, AOC acquisition, was successful at a valuation that met that threshold. That is not to say we will not pursue synergy. We will, of course, pursue synergy effectively. For example, the purchasing departments are already working together. And I have spoken with the CEO of AOC about doing everything thoroughly wherever they belong, AOC or Nippon Paint Group. In addition, AOC's business system has inspired the management teams of many of our partner companies, and they are all eager to learn from it. Our strength lies in the idea that these movements are not led by the headquarters, but rather that each business company thinks independently. And of course, we will help if the point of contact is unclear. By doing so, we aim to achieve both autonomy and accountability, and the motivation and performance of each company will steadily increase. I've already explained a great deal about the organic status and initiatives in February. To repeat, our business is fundamentally linked to the economic growth of each country and region. And in addition to factors such as population growth and per capita GDP growth, we can achieve growth that exceeds GDP by expanding our market share. In that sense, the demand itself, especially decorative business, is not cyclical. And coupled with the strength of our brand, which I explained at last year's IR Day, we believe stable growth will continue, and we have made no changes to our basic medium-term growth forecast. Recently, we have been receiving fewer questions on China, and to be honest, the market environment is by no means favorable. However, we continue to deliver profitable growth, and China remains an area in which we will continue to focus on growth. Based on the summary above, we have once again reviewed our asset assembler model on page 4. We compound sustainable EPS both organically and inorganically, which are naturally interrelated. In other words, after assets acquired through M&A join the group, we will steadily grow EPS while pursuing synergies through autonomous and decentralized management and collaboration within the group. With the acquisition of AOC, I think we can have a more concrete image of that. But of course, we fully understand that it is essential to produce results in the future. Next, page 5, please. Here is a summary of our M&A strategy. The acquisition of AOC is exactly in line with the policy we communicated last year, in April last year, and we believe that we fully demonstrated our advantages in M&A through this acquisition. As I said at the time of the announcement in October last year, the acquisition of AOC is not the goal, but just the beginning, and we want to continue pursuing acquisitions that have low risk and good returns with agility. The strength of our portfolio is that all companies are basically growing autonomously and are in position to generate cash. So there are no must-do deals without which our business becomes unviable. As a result, while we of course want good companies, we are in a position to decide to forego if they are not profitable. This allows us to avoid to overpay. As for funding, as I will discuss later, we have been able to maintain extremely high cash generation capability even after the AOC acquisition, so we have a reasonable amount of debt capacity. However, if sufficient EPS accretion is ensured, we will also consider equity financing. And in that sense, the fact that this platform allows us to pursue unlimited upside potential is our strength, along with the low-cost funding capability. Next, page 6, please. The acquisition of AOC will add a new pillar to our portfolio, which will significantly change our consolidated margins, cash flow, and profit structure. The contribution in 2025 will be for 10 months, and although AOC's guidance is based on the assumption of an extremely uncertain environment, including tariffs in the US, we expect margins to be maintained and sales revenue to decline slightly in volume. We have been checking monthly performance since the announcement, and even in a tough environment, the contribution margin has been firmly maintained and expanded. In the medium to long term, there's no change in our view that sufficient growth is expected due to lower interest rates and economic recovery in the US and improved margins in Europe. When we announced this acquisition last year, I talked about their excellent business system, high profitability backed by small capex burden and cash flow generating capability as the strength of AOC. I said that the reason their capex burden is low is because they operate using a process similar to paint manufacturing using reactors, and the facility can be used for a long time if it is maintained well. To give you a better image, please look at the video on AOC plant in Tennessee. The operations staff who did the plant tour as part of the due diligence confirmed that it is extremely organized and efficient, and the scheme is quite similar to paint plants. I hope this video serves as a reference for you. Please turn to page 7. This slide is the summary of organic results, and from page 8 onwards, I will update on individual markets. The summary was mentioned at the beginning. And basically, although there have been some ups and downs, we have achieved steady and stable growth and believe that it is quite possible in the future. I would like to explain the contents of pages 8 and 9 if there are questions later. Next, page 10, please. The description of China basically remains unchanged from our past messages. I think that there is still room for growth in decorative paints compared to developed countries, and that it is one of the few growth markets in the maturing world and has ample potential going forward with regards to automotive paints.
Page 11. As the asset assembler model takes shape, we are updating our guidance for FY 2025. For existing businesses excluding AOC, there are no changes on a local currency basis, but the yen has strengthened slightly compared to February, so we have made downward revisions based on the exchange rate assumptions shown in the lower right corner. However, given the 10-month contribution from AOC and a transfer of fixed assets at the Shinagawa office, overall, we have made a significant upward revision for operating income. If I were to give you a verbal overview of the changes in EPS, the original guidance was 57.1 yen EPS. The impact of the stronger yen was approximately minus 2.7 yen. The contribution of AOC for 10 months was approximately 12.5 yen positive, and the sale of fixed assets in Shinagawa was approximately 1.9 yen positive, so the new guidance is approximately 69 yen in total. There are 2 points to note regarding AOC's EPS contribution of 12.5 yen. The first point is that the contribution of AOC is assuming a certain PPA purchase price allocation estimation following the due diligence at the time of acquisition, taking into account the amortization of intangible assets. But the actual PPA will begin after the closing and will be finalized in the second half of the year, so there is a possibility that it will change slightly. Secondly, this figure takes into account the one-off acquisition costs for FY 2025. Specifically, it includes, for example, advisory fees, insurance costs, and estimated step-up costs for inventory due to PPA, all one-time costs. Again, the step-up costs for inventory are just estimates, and the final figure will be determined in the second half of the year. Roughly just over 3 billion yen after tax, or about 1.3 yen in EPS, has been subtracted. Therefore, AOC's regular contribution, based on 2025 forecast, would be 12.5 plus 1.3 equals 13.8 yen for 10 months, or about 16.5 yen per year, based on this calculation for 10 months. This is, of course, the figure after interest payments associated with the acquisition. The set figures are rough estimates, and AOC's performance this year will fluctuate depending on the results of the PPA and the interest rate level. But we have provided this supplementary explanation in the hope that you will recognize the significance of its contribution. Page 12. This is an update on cash flow. As I mentioned last year, in 2023, we strengthened our collection efforts, particularly in China, resulting in a very strong cash flow. Although it has declined slightly since then, I think we have continued to demonstrate strong cash generation in 2024. As a result, leverage at the end of 2024 was less than 2 times net debt to EBITDA. And although we only took into account the acquisition of AOC at the end of 2025, even so, it was still at a level of just over 3 times, which is a safe enough margin. And in addition, AOC's ability to generate cash is extremely strong, So I think it will be possible to reduce it to just over 2 times again by the end of 2026 if there are no other acquisitions. So as I mentioned earlier, we will be able to continue pursuing M&A opportunities. Our approach to share buybacks is the same as last year, which is that we are not satisfied with the current share price level, but we plan to use our valuable capital for M&As with future potential of generating revenue. And we are not considering share buybacks at this time with a view to building up sustainable EPS in the longer run. Having said that, we will keep our stance that we will be always watching the market and keeping all options open for the future. Page 13. Some investors have pointed out that they do understand what we're saying, but it's no good if the share price doesn't go up, which is reasonable. We continue to strongly feel that we want to reward the shareholders who have invested in us because they empathize with our policies, and how to close the valuation gap is our ongoing challenge. On this page, I am discussing the 3 points once again. The first is that we are committed to EPS based on our mission of MSV, and that we are a company that is an EPS compounding machine, whether organic or inorganic, and that we would like you to recognize this along with our track record. Second is our management style free of ego. This is not just about me or Yuichiro personally, but it is a management style that does not allow anything that doesn't go along with our mission, and I think that this is something that people can have more confidence in. I know that this is a bit of a self-praise, but I think that our management, which purely pursues MSV and is carried out by both the executive and the board of directors working together, is something that is hard to find elsewhere. Thirdly, at our core is the idea of achieving a solid balance between growth and safety. In addition to the proven resilience of our base business, which has survived the pandemic and severe inflation, if we can leverage our strength and carry out safe M&As, which is a term that includes the safety of the target business, the soundness of the valuation, ability to trigger autonomous growth after acquisition, and sound balance sheet management. And if we get to repeat such M&As, that can make everyone feel a little more secure, I think we will naturally be able to share our growth image. At the strategy session held with all the directors following the previous general meeting of shareholders, I shared a spreadsheet with everyone. This spreadsheet is extremely simple, but it is a single sheet that summarizes our roadmap for the next 10 years. And in particular, it is something that I and Yuichiro have shared from time to time since our joint appointment as co-president and Go-Hub Jin's appointment as chairperson in 2021, and it has been updated since then. This spreadsheet explains how we can simulate based on many variables such as organic net income, acquisition price, acquisition multiple, interest rate level, growth rate of the acquisition target, cash conversion, resulting consolidated net debt to EBITDA, debt to equity ratio, amount of new shares issued in case of equity financing, and PER of our company's shares. And that this is a roadmap on how to safely and continuously implement M&A and maximize shareholder value. Although I will refrain from giving specific numbers, if we think about it more simply, we can recognize a considerable upside. Even though it is conditional that we carry out the right M&A with a sound sense of caution at a sound multiple, it is achievable. And we have discussed this point with all the directors and have reached an agreement on the feasibility. However, to avoid miscommunication, I emphasize that M&A is a means, not an end in itself. Each target company has its own unique risks and opportunities, so we will not blindly pursue M&A at random, but will carefully assess each case before proceeding. These are shown in a little more detail with a chart on page 14. Each bar and line has no particular meaning. So this is not for you to approximate what is the number shown by bars and lines, but instead, the top row shows the image of continuous growth through organic and M&A activities, and the bottom row shows the elements that contribute to improving PER. We're not trying to step into an unprecedented level of PER, but our focus is rather how quickly we can return to the previously achieved level. Finally, a summary. Our company's sole mission is MSV, and we will continue to pursue the maximization of long-term EPS as well as short-term EPS by leveraging the superiority of our asset assembler platform. MSV is a concept that seeks to maximize the remaining shareholder value after fulfilling our limited responsibilities to our shareholders, which should be the one and only mission for a public company. It is the management's mission to strive for unlimited but safe growth. In organic growth, we will pursue maximizing the potential of our assets, and in M&A, we will carefully assess the balance between risk and valuation, both of which will contribute to compounding EPS. We will keep aiming to maximize PER by building on our track record and creating the right expectations for the future. We will continue to communicate with the market and produce results. So we look forward to your continued support. This concludes my presentation, and I would now like to take questions from the audience. Thank you for your kind attention.